Let's talk about high yield bonds. So, high yield bonds or high yield debt really refers to most commonly borrowing with credit ratings of triple B or worse. And this enables sponsors to increase leverage to levels the bank debt or leveraged loans won't support. So let's take a look at the high yield bond volume that's backed LBOs over the last 8 years. And you see that again, pre-crisis, it was significant, and then no high yield bond volume for about a year, followed by kind of the reemergence of it. It's still a fraction of what it was. High yield debt investors are comprised of primarily pension funds, insurance companies, and mutual funds. That other category includes ETFs, high net worth individuals, commercial banks, as well as hedge funds. So this is who provides this type of capital. And obviously there's a lot of crossover with the investor base for the leveraged loans. It's just depending on kind of which particular pension fund or mutual fund and the risk appetite of that particular fund will kind of determine which sort of tranche they participate in. So in terms of the pricing on high yield bonds, it's a fixed coupon, paid semi-annually. Maturity is usually 7 to 10 years. No principal paydown, unlike the term loan, until the maturity. That's called a bullet payment. And you see that the yields on bonds were in the 7 to 8% ballpark up until the financial crisis. Lehman bankruptcy was already at 11 or 12%, spikes up to above 20%, and now has dipped down below the pre-crisis levels. So if we look at our case study, we're actually going to build a full-scale LBO model for BMC, and you can see that in that deal, it was a $6.7 billion LBO. Bain and Golden Gate were the private equity firms that sort of ran that LBO. It included a $1.6 billion bond with an 8% coupon, priced at par, matures 7 years after or 8 years after it was issued, not callable for the first 3 years. So this is a distinction from term loans. Bonds are not callable for usually the first 3 or 4 years of the loan. Senior tranches were comprised of a $2.88 billion LIBOR plus 400 basis points with a 1% floor tranche, and a $670 million LIBOR plus the 4% secured 7-year term loan, and a $350 million unfunded revolver with the same pricing. So that's a capital structure that we're going to have to incorporate into our model. High yield bonds are usually, but not always, unsecured. So we talked about how they're usually unsecured, and you see that the majority certainly are unsecured, but some are secured. And when they make up kind of the only part of the capital structure, it is not unheard of that they get some sort of security, either a first lien or a second lien. Let's talk about some other features of high yield bonds. So one of the interesting features of high yield bonds is that initially they're not registered with the SEC usually, and you can do that with using something called Rule 144A, which allows you to get to market quickly in terms of the bond offering. But then ultimately most high yield bonds do end up getting registered. That just enables the bond to get more liquidity, to be traded more freely. Then it's registered. It takes about 3 months. So it starts being unregistered following Rule 144A. Then they go through the process of registering it, and it usually is exchanged for registered debt once the SEC paperwork is done, which increases that liquidity. As we talked about, it has call protections and call premiums. Let's just kind of provide an example of what that is so that everybody's clear. So call protection is a way for the investors that provide the high yield bonds to protect themselves from the borrower actually calling the bond. Of course, you're in the business of collecting interest payments. If the borrower can at any moment call the bond, there's risk to your cash flows. And so call protection is something that banks don't provide, they don't require, which is a benefit to the borrower, but that bondholders do require. So here's an example: a 10% note due in 8 years with 3 years of call protection. By the way, the notation for that is NC, non-callable 3, which means 3 years of call protection. This is actually more common. It used to be that if you're doing an 8-year term bond, a bond with a term of 8 years, you'd have 4 years of call protection. Now it's a little bit less as the capital markets environment, again, is getting looser and borrowers can kind of dictate terms. It's gone down to 3 years. So after 3 years, the bonds are callable at 105% of par. So this is just an example. So you see that once after the third year of call protection is over, there's still call penalties for the borrower. So if the borrower is going to call the bond even after the call protection, they would have to pay back to the lenders 105% of par. The following year, at the end of year 4, the call premium will typically dip down, sort of in a percentage basis. So it'll dip down from to a 5% call premium, right? 100% plus the 5%, down 33% effectively to a 3.3% call premium. Then another decline to 1.7% premium, and then par in the following years thereafter, which represent, the notation for that is par plus 50% coupon, then 33% and 17% and par over the next 3 years.